Society constantly feeds us this idea that reaching a high credit score means you've finally made it. Like you've conquered the system, right? You've won the financial game. But what if the very metric designed to reward your financial discipline is actually a carefully engineered trap? In this explainer, we're diving straight into the stark reality of the credit industry and looking at exactly why having quote unquote excellent credit is exactly what keeps so many people effortlessly and dangerously poor. Picture this. You open your credit monitoring app in the middle of the night, and there it is, a glowing 7 of 50 staring right back at you. Suddenly, banks love you. Lenders trust you. You're getting flooded with offers for premium cards, massive car loans, sprawling mortgages. It feels like wealth, doesn't it? But that glowing number, it's an illusion. A 750 score doesn't actually mean you have a massive safety net. It doesn't mean you're financially secure, and it for sure doesn't guarantee you're debt-free. It's literally just a metric that tells lenders it's safe to open their vaults to you. The reality here is pretty simple, but is crucial. A credit score is not a bank account balance. It doesn't measure how much wealth you actually have. Its only real function, to estimate your statistical likelihood of repaying borrowed money. So your reward for being a disciplined borrower isn't actual wealth. It's just the temptation of larger limits. You aren't being handed a financial safety net. You're basically just being handed a bigger shovel so you can dig a deeper hole. Let's break down the psychology of this for a second. Say you want a $3,000 television, but your checking account is completely empty. If you were paying with physical cash, the friction would be immediate, right? It would literally hurt to watch your wallet empty out. But with a piece of plastic or just a tap of your phone, that crucial friction just vanishes. You swipe, you get that instant gratification of walking out with a TV. And the pain of actually paying for it? Well, that's delayed. This psychological distance tricks our brains. It removes the immediate sting of cash depletion and makes spending feel just way too easy. And right here is where the trap snaps shut. If you pay that balance in full immediately, okay, you've used the card as a simple cash flow tool. No harm done. But the absolute second a balance carries over, that original $3,000 purchase price begins to rapidly inflate. Unlike a one-time fee, interest is a compounding premium. So you're no longer just paying for a television. You are paying a massive, silent tax just for the privilege of consuming today rather than waiting until tomorrow. This invisible inflation leads us to a highly dangerous threshold. This is the exact moment your credit card stops being a convenience and transforms into the debt cycle. What's the debt cycle? It's using tomorrow's income to pay for yesterday's spending. You are actively paying for a lifestyle you've already consumed using money you haven't even earned yet. It goes from being a handy tool to an expensive, permanent drain on your future paychecks. Now, lenders know exactly how to keep you comfortable while you're stuck in this cycle, and they do it by utilizing the most powerful feature of credit cards, the minimum payment. When your statement arrives, you see this massive total balance that honestly should trigger a little panic. But right below it, illuminated as the primary call to action, is this tiny, highly manageable minimum payment. It's an absolute masterclass in psychological design. It's built to pacify you while you quietly cover nothing but the compounding interest month after month. To actually break out of this illusion, we have to clarify a fundamental distinction. We absolutely cannot confuse a credit score with a net worth score. A pristine credit profile is built purely on your borrowing behavior. You can have an immaculate top-tier credit score while quietly drowning in heavy consumer debt. On the flip side, your net worth, which is your actual assets minus your liabilities, that tells the real truth. It is entirely possible to have literally no credit score at all while sitting on immense, quiet wealth. They measure two completely disconnected realities. But credit companies, they are masters at blurring these two realities together. Just imagine your phone buzzing with a push notification saying your credit limit was just increased from $5,000 to $10,000. For the human brain, this triggers an immediate dopamine hit. You suddenly feel twice as wealthy, your available spending capacity just doubled, yet think about it, you haven't actually earned a single extra dollar. It's phantom wealth. It's completely engineered to tempt you into upgrading your lifestyle to match an artificial limit. And this phantom wealth creates a really dangerous blind spot. It blurs the line between I can charge this and I can actually afford this. If you're standing outside a luxury storefront window, your inflated credit limit easily answers that first question. Yes, for sure, the plastic will swipe successfully. But actual affordability? That's dictated by real income and cash savings. Confusing your spending capacity with true affordability is exactly how high-income earners end up completely, shockingly broke. So this creates a silent, invisible crisis, and it perfectly explains why even really decent earners feel permanently impoverished. Just consider the division of tomorrow's income.
A large chunk rightfully goes to housing. Another goes to basic living expenses. But then, a massive, suffocating slice is already claimed by yesterday's spending, the compounding interest and minimum payments from past choices. The money is literally gone before the paycheck even clears the bank.
Which brings us to the ultimate trap of all of this. Approval means they will lend to you. It absolutely does not mean it is affordable. A bank's willingness to lend you, say, $20,000, is based on their sophisticated risk models dictating that they can eventually squeeze that capital plus heavy interest out of you over time. It has zero correlation with your personal capacity to safely absorb that debt. A loan approval is a calculated business transaction, guys. It is not a financial advisor's blessing. So, if we strip away the illusion of the credit limit, what should we actually be looking at? Well, true financial health requires concrete, real-world metrics. You must track your actual cash savings, your stable income, your real-world expenses, and your true net worth. These are the hard numbers that actually measure the strength of your financial fortress. Relying on a credit score to gauge your financial health, that's kind of like using a speedometer to check your gas tank. It just doesn't make any sense. Before you take on a new loan or swipe for a massive purchase, you really need to pause and ask the hard questions. Like, can I comfortably make these payments if my income falls? Don't just look at whether you barely qualify today under absolutely perfect conditions. You have to stress test your life. If missing a single paycheck means everything comes crashing down, then you cannot afford the debt, no matter what that shiny approval notice says. We really have to unlearn a fundamental lie sold to us by a debt-driven society. You know, the most dangerous sentence in personal finance isn't "I can't afford this." Admitting you can't afford something is actually incredibly safe. No, the most dangerous sentence is "I can afford the monthly payment." Sacrificing your future income and your peace of mind just to maintain a lifestyle via endless monthly installments, that guarantees a disastrous financial future. You just end up owning nothing while paying for everything twice. Our whole system pushes us to obsess over building credit, primarily so we can just access more debt. But the smartest financial move isn't borrowing more, it's needing to borrow less. True financial freedom isn't measured by a high credit limit, it's measured by how much of your own income you actually get to keep. So take a hard look at your pristine credit score and ask yourself, what doors is this actually opening? Are they doors to true financial freedom, or just doors to a shinier, much more expensive cage?